If you were not in the market in July, you might have missed 50% of this year's returns.
Today, ladies and gentlemen, so many of you have been asking me, is this the bottom of the market? Are we seeing a new bull market, or is this a bear market trap that's going to wreck our dollars because we haven't seen the full impact of this recessionary period? And damn it, if only I knew, I would take all the money I have and be a millionaire in the coming months, taking crazy options out against exactly what I knew what was going to happen with these stock prices. I can only follow my intuition and do what's best for me, and I hope you can learn from that. But if there's one gentleman that clearly knows and has a better intuition behind the market with much more years of experience than I do, of course, it's Kevin O'Leary. And he recently posted a video. It was a long one. I left the full link in the description below, but I wanted to break pieces of it down because he says very intriguing things about the jobs market, this recessionary period, why it's different. He talks a little bit about the interest rate hikes and inflation. So we're going to break all of this down, and if that's the conversation you can appreciate in return, I simply ask that you hit that like button. But let's get right into this.
We're in a really strange situation now. There are, 2 jobs for every available employee in America. And so this is unusual that we'd be in technically what should be a slowdown according to, many market pundits. And yet we're at full employment, under 4% unemployment right now. So it's challenging.
Yeah, this is the most intriguing thing because every recession, go look back in history, the dot-com, the 2008, the 1980s, all of those periods saw incredibly high unemployment rates. But for some reason in this recessionary period, we're actually seeing incredibly low unemployment. And obviously jobs are strong, even though we're hearing from companies doing layoffs, obviously, hiring freezes. But the fact of the matter is that's a very particular part of the sector of the economy, because when you're talking about airline travel, restaurants, even construction with the slowdown in real estate, are having a hard time keeping basically just employed people that aren't willing to leave or walk off the site a month, 3 months later, looking for better income-based jobs. And those jobs are actually paying a lot more than they historically have in the past. So it's really hard to wrap your head around what does that mean for the general economy. And when we're talking about earnings specifically, after all these earnings period with Apple, Microsoft, Google, they are still trucking in record revenue numbers over last year, which was the boom coming out of the pandemic and everyone moving into this in-home lifestyle. So there's clearly some really strong fundamentals here, even though we're seeing a slight slowdown in GDP, which I've called kind of a self-fulfilled prophecy. We're all freaking out a little bit, and it's hard to gauge, how bad the economy is with all the helicopter money, all this strong, strong employment, and it's just so hard to understand what's going on, which is why I do not try and predict this stuff. But let's continue on.
This recession or this slowdown doesn't look like it's going to be a hard one. It's going to be an economic slowdown, but probably not as harsh as historic recessions that usually last for 18 months. And I think the primary reason is free money from helicopters never stops. We're printing more and more and more money than ever before in any economy ever. And if this bill goes through, it's even more money. And the only negative to that is perpetual inflation. That's what the outcome is.
Yeah, there's 2 sides to inflation, right? Like commodity inflation, and then there's money printing inflation. But basically the way the Federal Reserve works is they need to keep unemployment low, right? Like they need to keep people employed, and they can really only use a couple tools, which is print money or raise the interest rates and pull money off the table. But because the underlying GDP is still really strong, I don't like how everyone just focuses on the money printing they're doing, All that money printing is based off the fundamentals and asset value of the entire economy, right? So it's really hard to wrap your head around the benefits or obviously the lack thereof when they're doing this. And it's a conversation that's for like economic experts, which is definitely not me. But he does continue to comment on some of the commodity stuff here that I did not know about the oil markets. So we'll continue listening.
Every recession has its own personality. This one is different. There's no question about it. It's self-imposed. There's 2 major sources that consumers feel in inflationary times that usually trigger a recession. One is energy prices and food prices, and we have inflation in both of those. But they're all, in some ways, self-inflicted. Energy is just bad policy, shutting down pipelines, removing the leases from the Gulf of Mexico and Alaska. All of that was a mistake. Can't have an economy without hydrocarbons. Now we've figured that out. We're trying to change it in this bill a little bit. So hopefully that can be fixed, but it'll take a long time. And here's the primary reason that nobody really talks about. We haven't built a refinery in this country since the 70s. we are down. We need 3 more refineries, and the administration recently canceled one that was about to come online. So we can't actually make any more gasoline than we're making right now. And hopefully we don't have a catastrophe in one of the existing refineries, like a flood or a storm or whatever, that takes more capacity offline. So that's very, very broken.
You know, as oil comes down, it really drags down the rest of inflation, because obviously everything is shipping related, from our food products, Amazon, all that stuff. So we should start seeing hopefully some easing up, which will lower some of those prices, and again, stop inflicting such high inflationary pressure. And the fact that jobs are good and wages are good, that usually is a sign that, you know, we should start finding a balance here. But again, I don't know if, again, a black swan event comes and just skyrockets oil again. Nobody really knows from that aspect. But what an intriguing conversation to be had. Now, he does mention one more thing when we're talking about interest rates, which obviously is a huge topic. So let's listen.
The market took that 75 basis point rate hike and actually celebrated it, that it wasn't 100 basis points, and that Powell was talking about maybe, you know, being stop and see what the results are of these moves in assessment if the data changes. But I would say there's probably another 75 basis points of rate hikes before he stops. But even that leaves us at historically low interest rates. So it's not as impactful as history in other times, the 70s, for example, when we had interest rates as high as 17, 18, 19%. We're not in that place right now because this economy is far more productive.
Yeah, that's another really bullish sentiment, right? Like, obviously we're seeing the highest rate hikes we've seen in decades, but the fact is these are still insanely historically low. I think in Canada we're at what, like 2.5%, and everyone's freaking out over that, even though we're nowhere near the highs we used to be. And on that matter, I don't think they're gonna pump it too hard. I would be surprised, like he says, another 0.75 basis, maybe 1% at most, and then the Fed will become more accommodative as inflation cools off, because again, this is purely to get inflation under control. And if it starts hindering the jobs market and we start seeing that data come in from the layoffs and the hiring freezes, and maybe it is a little bit more broad pronounced than even I'm anticipating, considering again the strong jobs numbers and airlines and all that stuff, and them struggling to get employment, it's going to be interesting to see what they do. But I do believe inevitably they're going to become accommodative as inflation cools down, and that's going to help push the continued rally back from the lows that we've experienced. So again, the latter half of this year, I think we're going to experience extreme volatility. There's no doubt about that. But when you look ahead, presuming there's no other black swan slap you upside the head kind of a geopolitical event like we've seen with Ukraine, I can't see us not kind of finding a nominalization here. And whether we head back to all-time highs in the next 6 to 12 months is up to anybody's opinion. And Jamie Dimon from JP Morgan said there is a storm on the horizon, and when it comes to shore, we just don't know how hard those impacts are going to be. And honestly, when you look at the data right now, it's really up in the air. But I'll pass the question off to you. I'd love to know what you guys think about the current market environment. Do you think we've seen the bear bottom lows here and we're going to start rallying back? Do you think we're going to see continued downside based off, you know, real estate starting to get hit? I mean, we may not even see the full impacts of the value just evaporate from the real estate market, especially here in Canada with a 20% drop. Who knows what the ramifications are going to be, but those will become more pronounced as the months follow. And if you want to continue this conversation, just consider subscribing, because of course I'll always come back here, update you guys, and obviously show you what I'm doing within my own portfolio. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.